The stock market is a marketplace where investors buy and sell shares of publicly traded companies. When you buy a stock, you're purchasing a small ownership stake in a business. If that company grows and becomes more valuable, your investment can increase in value as well. This simple concept has helped millions of people build long-term wealth. Companies go public because they need money to grow. Instead of borrowing from banks, they can sell shares of ownership to investors. This process is called an initial public offering, or IPO. Once public, the company gains access to capital while investors get the opportunity to participate in the company's future success. Every year, millions of Americans invest in the stock market hoping to grow their wealth and secure their financial future. Yet many people still believe investing is too complicated or too risky. The truth is that understanding at its core, the stock market runs on supply and demand. When more investors want to buy a stock, demand increases and prices tend to rise. When more investors want to sell, supply increases and prices often fall. Today, buying stocks is easier than ever. Investors can open brokerage accounts online and purchase shares directly from their phones or computers. What once required calling a stockbroker can now be done in seconds through modern investing apps. NASDAQ is another major stock exchange in the United States. Unlike the NYSE, NASDAQ is known for listing many technology companies. Some of the world's biggest innovators have traded on NASDAQ, making it one of the most influential exchanges in global finance. A bull market occurs when stock prices rise over a long period of time. During bull markets, investor confidence is usually high, businesses are growing, and the economy is generally strong. Bull markets have historically created enormous wealth for long-term investors. While no bull market lasts forever, they are a normal part of the market cycle and often reward patient investors. The New York Stock Exchange, often called the NYSE, is one of the largest stock exchanges in the world. Many of America's most established companies trade here. Every day, billions of dollars worth of stocks are bought and sold through this marketplace. Stock prices move because of supply and demand. When more investors want to buy a stock than sell it, the price generally rises. When more investors want to sell than buy, the price usually falls. News, earnings reports, economic data, and investor confidence all influence these movements. Think of a company like a giant pie. Each stock represents a small slice of that pie. The more shares you own, the larger your ownership stake becomes. Even if you only own one share, you're still considered a shareholder and can benefit if the company performs well. Growth stocks are companies expected to grow faster than the overall market. These businesses often reinvest profits back into expansion rather than paying dividends. Investors buy growth stocks because they believe future earnings will be much higher than today's earnings. While growth stocks can generate impressive returns, they can also experience larger price swings. Diversification means spreading investments across different companies and industries. The goal is simple. Never rely on a single stock to determine your financial future. If one investment performs poorly, others may perform well. Diversification helps reduce risk and creates a more stable portfolio. Many professional investors consider diversification one of the most important principles of successful investing. Compound growth is often called the eighth wonder of the world. It happens when your investment returns begin generating their own returns. Over long periods, compounding can transform small investments into substantial wealth. This is why many successful investors start early and remain invested for decades. Time is often more important than trying to find the perfect stock. The 2008 financial crisis was one of the biggest market crashes in modern history. Stock prices fell dramatically as banks and financial institutions faced serious problems. Many investors panicked and sold their investments. However, those who remained invested and stayed patient eventually benefited from one of the strongest recoveries in stock market history. Lesson is clear: short-term fear should not override long-term strategy. In early 2020, global markets experienced another major crash due to the COVID pandemic. Investors around the world feared economic uncertainty, causing stock prices to fall rapidly. Yet within months, markets began recovering and eventually reached new highs. This event reminded investors that markets often recover faster than expected and that patience can be one of the most valuable investing skills. Some companies share part of their profits with shareholders through dividends. These payments can provide investors with regular income even if they never sell their shares. Many retirement investors prefer dividend-paying stocks because they create a steady stream of cash flow. Over time, reinvesting dividends can significantly increase total investment returns. An ETF, or exchange-traded fund, is one of the easiest ways for beginners to invest. Instead of buying a single company, an ETF allows investors to own small portions of many companies at once. This provides instant diversification and reduces risk. Because of their simplicity and low costs, ETFs have become extremely popular among American investors. One of the most important lessons every investor must learn is that market crashes are normal. Stock markets do not move up forever. There will be periods of fear, uncertainty, and sharp declines. While crashes can be frightening, history shows that markets have recovered from every major downturn. Investors who stay calm and focus on the long term often come out stronger when the market eventually rebounds. Many beginners make the same mistakes. They follow hype on social media, buy stocks without research, panic during market declines, or try to get rich quickly. Successful investors understand that investing is not gambling. It requires patience, discipline, and a long-term mindset. Avoiding these common mistakes can dramatically improve your chances of success. For beginners, building a diversified portfolio is often a smart starting point. Many investors begin with broad market ETFs because they provide exposure to hundreds of companies. Over time, investors may add individual stocks based on their goals and risk tolerance. One of the most respected investors in history is Warren Buffett. His approach is surprisingly simple. He looks for strong businesses, invests for the long term, and avoids emotional decisions. Rather than chasing trends, he focuses on companies with solid fundamentals and competitive advantages. His success demonstrates the power of patience and disciplined investing. The ultimate goal of investing is not simply making money. It's creating financial freedom. Investing allows your money to work for you rather than relying entirely on active income. Over many years, consistent investing can help fund retirement, provide financial security, and create opportunities that might otherwise be impossible. The earlier you start, the more powerful this process becomes. Let's quickly recap. Stocks represent ownership in businesses. Companies go public to raise capital. Investors can earn money through stock price appreciation and dividends. Diversification helps manage risk, and long-term investing remains one of the most reliable paths to building wealth. Remember, successful investing is not about getting rich overnight. It's about making smart decisions consistently over time. If you found this video helpful, be sure to like the video, subscribe to the channel, and turn on notifications for more stock market and investing content.